NVIDIA stock is now hovering around the 100 mark, a dramatic reversal for what's been one of the most iconic AI plays of the decade. After a historic run fueled by explosive demand for AI chips, NVDA is suddenly on the ropes. So what's happening? Is Wall Street just taking profits, or are we finally seeing the first real cracks in this AI superstock? Not long ago, NVIDIA was pushing new highs with a market cap nearing $3 trillion. But recently, the stock has dropped sharply, shedding serious value and shaking investor confidence. That raises the big question. Is this a rare buying opportunity, getting into the world's leading AI company at a discount? Or is there more pain ahead? Before we break down the numbers, make sure to hit that subscribe button and join the Stocks Telegraph community. We bring you sharp, data-driven stock insights every week. And let us know in the comments, are you buying this NVDA dip or waiting for the dust to settle? Several factors have triggered NVIDIA's pullback. One concern is slower growth in its data center segment. Microsoft recently scrapped some AI-related data center leases, suggesting a potential pullback in AI infrastructure spending. After a stunning 660% run since 2022, NVDA also became ripe for profit-taking. Macroeconomic headwinds, like rising interest rates, have further pressured growth stocks. Investors are recalibrating expectations amid higher borrowing costs and inflation concerns. Even with solid earnings, NVIDIA's latest guidance caused worry. The projected gross margin dropped to 71% from 73.5%, linked to increased costs for ramping up Blackwell chip production. Revenue guidance of $32.5 billion, while strong, still fell short of some sky-high analyst expectations. Layer in fears of AI saturation in the short term, where companies that overordered GPUs are temporarily holding off on fresh purchases, and you've got a recipe for uncertainty. Even the best companies face digestion phases after explosive growth, and NVIDIA may be entering one now. Despite the recent pullback, NVIDIA remains the backbone of the global AI movement. Its GPUs, like the H100 and upcoming Blackwell series, power everything from AI training to real-time inferencing across tech giants and startups alike. Meta is deploying over 100,000 H100 GPUs to train its Llama 4 model. Meanwhile, OpenAI, Google, and Amazon all rely heavily on NVIDIA's chips. But what keeps NVIDIA far ahead isn't just hardware, it's the software moat. CUDA is a powerful, industry-standard framework that's become embedded in AI development. Without it, switching to alternative hardware becomes a massive undertaking. That software stickiness gives NVIDIA time to adapt, iterate, and stay dominant, even as rivals catch up in specs. Financially, NVIDIA is still firing on most cylinders. In Q4 of financial year 2025, revenue reached a record $39.3 billion, up 12% quarter-over-quarter, and a massive 78% year-over-year. EPS climbed 82% to 0.89. Data center revenue hit $35.6 billion, representing nearly all of the company's top-line growth. Gaming revenue has cooled, dropping 22% sequentially and 11% year-over-year. But this isn't entirely unexpected, as gaming GPUs are more cyclical and less tied to the current AI boom. Margins dipped slightly due to increased R&D and chip production expenses, especially with the rollout of Blackwell. Free cash flow remains strong, and return on equity is robust. NVIDIA continues to aggressively invest in R&D, which bodes well for future innovation. It also resumed share buybacks, another sign of confidence from management. With NVIDIA now trading near $100, is it a steal? The PE ratio is around 32, well below its 12-month average of 53. The price-to-sales ratio sits at 18.5x, still elevated, but not at nosebleed levels. What's more encouraging is the PEG ratio at 0.95, suggesting growth may now be undervalued. A PEG under 1 is often a signal that expectations are more aligned with earnings potential. Compared to peers, AMD trades at a PE of 84 with a similar PEG. Broadcom sits higher on both metrics, while Supermicro, which boomed on AI server demand, remains cheap on a PEGI basis. So while NVIDIA isn't screaming cheap, it's a much more balanced valuation now. For long-term investors who believe in AI as a decade-long theme, this dip could be a solid entry point. The macro backdrop is adding to NVIDIA's volatility. Rising bond yields are putting pressure on tech stocks as higher rates reduce the value of future growth. And with inflation still sticky, central banks aren't signaling quick rate cuts. Geopolitical tensions are another wild card. The US is considering more export controls on NVIDIA's chips to China, especially its H20 model. If those rules are tightened, a major source of demand could be affected. China's own regulatory environment is also becoming more complex, with new efficiency standards for AI data centers possibly limiting future GPU sales. Wall Street is cautious but not bearish. HSBC downgraded NVDA to hold and trimmed its price target to $120, citing potential pricing weakness and Blackwell rollout uncertainty. However, KeyBank stuck with a bullish $190 target, saying any shipment delays are short-lived. Institutional moves are just as mixed. Coatue Management boosted its stake nearly 900%, now holding 13.75 million shares. That's a massive vote of confidence. But Citadel and D.E. Shaw have pulled back, signaling more conservative positioning. The average 12-month price target among analysts remains around $176, representing over 60% upside from the $100 mark. So while the tone has cooled, belief in NVIDIA's long-term potential remains largely intact. So does this pullback offer a true opportunity? On the bullish side, NVIDIA still controls AI's infrastructure layer, from the hardware to the software stack. Its innovation pipeline is full, its demand is global, and its brand is synonymous with the next wave of computing. If you believe the AI boom is still in its early innings, this dip is one of the best chances we've seen in months to enter. But the bear case is that expectations have been sky high, and even great companies can underperform when sentiment turns. Slower data center growth, higher production costs, macro headwinds, and growing competition could keep pressure on the stock in the near term. For long-term investors, this could be the rare moment when a best-in-class AI name becomes reasonably valued. But for traders or cautious buyers, waiting for further technical confirmation or macro stability might be the better play. NVIDIA's drop doesn't erase its AI dominance, but smart investors will weigh risk, time horizon, and conviction before hitting the buy button. NVIDIA near $100 steal of the year, or a value trap in disguise. The debate is just heating up, and we want to hear from you. Are you loading up at these levels, slowly averaging in, or staying on the sidelines? Drop your thoughts in the comments. Your insights might be featured in our next video. And if you love deep dive market analysis, cutting-edge tech breakdowns, and real-time investing insights, smash that like button, subscribe to Stocks Telegraph, and turn on the notification bell so you never miss a breakout opportunity. Thanks for watching, and we'll catch you in the next one.